wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets, and we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 219, and in this episode we're reviewing the performance of the financial markets during the 26th week of 2026, and that is from Monday the 29th of June to Friday the 3rd of July. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where a report from the Bureau of Labor Statistics on Thursday showed the job creation in the U.S. economy slowed down sharply in the month of June. Non-farm payrolls for the month of June increased by a seasonally adjusted 57,000 jobs, which was much lower than the downwardly revised number of 129,000 for the previous month of May, and significantly lower than the Dow Jones consensus forecast for 115,000 new jobs. Meanwhile, the unemployment rate surprisingly declined to 4.2%, but this was largely due to workers dropping out of the labor market, as the labor force participation rate declined by 0.3 percentage points to 61.5%, which, excluding the COVID-era jobs market, was the lowest participation rate in exactly 50 years. Prior months also saw significant downward revisions, with the May total cut by 43,000, while April's figure came down by 31,000, signaling some weakness in the U.S. labor market. And over to the Eurozone, where annual inflation unexpectedly slowed down to 2.8% in June 2026, dropping from 3.2% in May. While this cooling is driven by stabilizing energy and food costs, it remains above the European Central Bank's target rate of 2%, keeping policymakers cautious about any further adjustment to interest rates. A closer look at the data shows the following breakdown, with energy, which was expected to be the highest driver of inflation, slowing down to an annual rate of 8.7%, down from 10.8% in May. Meanwhile, core inflation, which excludes volatile food and energy prices, this slowed to 2.4%, down from 2.6% the previous month. And among major Eurozone economies, inflation slowed down in Germany to 2.4%, down from 2.7%, and in France it dropped to 2%, down from 2.8%. And over to China, where the economy is showing signs of picking up, thanks in part to a rebound in exports to the United States. China's exports to the US have picked up in recent months, growing by 11.3% and 35.4% in April and May respectively, and this follows double-digit declines for most of last year after President Trump implemented tariffs on Chinese imports. After a strong first quarter, the Chinese economy lost steam in April and May as retail sales for the month of May fell for the first time since the COVID pandemic. According to the China Beige Book, which is an independent survey of Chinese businesses, During the month of June, manufacturing saw the clearest improvement as retail sales also recovered. And over to the Far East, where on Tuesday, the Japanese yen weakened to the lowest level against the US dollar since 1986, keeping investors on alert for possible intervention from Japanese authorities. According to data from LSEG, the yen fell to 162.19 per US dollar, marking its lowest level in 4 decades. Japan's finance minister said that the government was ready to take appropriate action against excessive currency moves. The broader outlook for the yen remains weak, mainly due to the wide interest rate differentials between the yen and the US dollar, which continues to favor the carry trade, where investors borrow and sell the yen at a cheaper rate and invest in higher yielding assets like the US dollar, and this continues to put more downward pressure on the Japanese currency. On Wall Street this past week, the Dow Jones Industrial Average scaled to record highs on Thursday as investors reacted to a weaker than expected non-farm payrolls report for June, whilst the Nasdaq Composite languished as semiconductor stocks fell for a second day in a row. All the 3 major averages finished the holiday-shortened week with solid gains, with the 30-stock Dow Jones Industrial Average registering a weekly jump of about 2% as it added 594 points on Thursday before coming to a close at a record high of 52,900. Meanwhile, the broad-based S&P 500 rose by 1.8% during the week before coming to a close at 7,483. And despite the 2-day dip in tech stocks, the Nasdaq Composite still managed a weekly increase of about 2.1%, even though it dropped by 0.8% on Thursday to close at 25,832. In the Treasury bond market, short-term Treasury yields fell on Thursday as investors digested the lighter-than-expected jobs report that suggested the Federal Reserve could hold off on hiking interest rates later this year. The probability of a rate hike to cope with rising inflation declined sharply following the release of the latest payrolls report, which showed a much weaker-than-expected jobs number for the month of June, pointing towards stagflation, which refers to a stagnant economy accompanied by rising inflation. The yield on the short-dated 2-year Treasury note dropped by more than 2 basis points to close at 4.137%, whilst the yield on the benchmark 10-year Treasury bond inched up by 1 basis point to trade at 4.485%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil was little changed on Thursday after Qatar said that the US and Iran had made positive progress during their indirect talks. Mediators from Qatar and Pakistan concluded separate meetings with the US and Iranian negotiators in Doha on Wednesday and confirmed that positive progress was made on issues related to the Memorandum of Understanding. And in related news, Saudi Arabia has ramped up oil shipments through the Strait of Hormuz since the US and Iran signed an agreement to reopen the strait last month. According to data from the trade intelligence firm Kepler, the Saudis have shipped about 34 million barrels of oil through the strait since the 17th of June. In response to the foregoing, the price of the international benchmark Brent crude rose by 23 cents on Thursday to close at $71.80 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, gained by 11 cents to settle at $68.69 per barrel. In the precious metals market, the price of gold rose by 1.4% on Friday morning, putting the precious metal on track for its first weekly gain in the past 5 weeks, after coming under sustained pressure since the war against Iran began in late February. Gold prices have fallen this year with concerns about rising inflation and a hawkish stance from most major central banks in the wake of the US-Iran war, denting the appetite for the non-yielding metal. According to the CME's FedWatch tool, the probability that the Fed will hike interest rates by at least 25 basis points in September has reduced from 65% before the jobs report to 53.5% this week. The precious yellow metal posted its worst quarter in 13 years in the 3 months to June and is still trading at a discount of around 22% from its all-time high of over $5,300 that was hit in January 2026. The price of spot gold was on track for its first weekly rise since late May, as it rose by 2.3% during the past week before eventually settling at $4,182 per ounce. Up next is a quick review of the African financial markets, and we start in Ethiopia, where on Monday, after more than 2 years of negotiations, Ethiopia said it had reached a preliminary agreement with key bondholders to restructure its defaulted $1 billion international bond. The government said that a new agreement has been reached in principle with an ad hoc group of bondholders on restructuring its defaulted $1 billion international bond, and this deal includes the repayment of $880 million in installments by 2029. Moving over to Ghana, where Ghana's Statistics Service released data on Wednesday showing that the annual rate of consumer inflation rose for the third consecutive month, rising from 3.7% in May to 5.3% in June. According to the data, the increase in inflation was mostly driven by non-food prices for transport, housing, and education services. The report showed that even though price pressures have started to rise again, inflation remains far below the rate of 13.7% that was recorded for the same month last year. And in other news, China's central bank has authorized Standard Bank South Africa and Industrial and Commercial Bank of China to clear renminbi payments across Africa as China steps up efforts to promote the global use of its currency. This move gives businesses and financial institutions a direct access to China's onshore financial system for the first time, including capital markets and liquidity infrastructure, and in the process will streamline cross-border trade and investment flows. This move by the People's Bank of China is one of many by China to internationalize the yuan and reduce dependency on a global payment system that is dominated by the US dollar. According to Chinese customs data, trade between China and Africa rose by nearly 18% last year as Beijing removed all tariffs on imports from 53 African nations starting on the 1st of May 2025. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where the headline rate of inflation eased to 6.4% in June, down from 6.7% in May, reflecting a moderation in the impact of global oil prices as well as domestic food prices. Meanwhile, core inflation, which excludes food and energy prices, this declined marginally from 3.2% to 3.1% in June, driven mainly by a decline in prices of select processed food items. And over the same period, non-core inflation, which focuses on food and energy prices, this also decreased from 16% down to 15.1%, largely supported by a moderation of food and energy prices, plus transport costs. In the domestic foreign exchange market, during the past week, the Kenya shilling appreciated marginally versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.30 compared to 129.63 that was recorded the previous week. Meanwhile, the sterling pound was priced at 171.65 and the euro was valued at 147.30. And on the regional front, one Kenya shilling was changing hands for 28.36 Ugandan shillings and 20.30 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.32. Despite the conflict in the Middle East and the subsequent increase in oil prices, the Kenya shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by a staggering $874 million for a grand total of $14.04 billion, which is equivalent to 6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The sharp increase in forex reserves could be attributed to the recent approval of a $750 million facility by the World Bank. However, that is still subject to confirmation. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, This averaged at around 32.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 2nd of July, and the Central Bank of Kenya received bids totaling to 35.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 146%. The Central Bank accepted 24.7 billion shillings, and the results of the auction were as follows. The 91-day rate ticked up by less than 1 basis point to even out at 8.83%, whilst the 182-day rate shot up by 12 basis points to settle at 8.96%, and the 364-day rate remained relatively unchanged at 8.99%. Please note that over the past few weeks, the Treasury yield curve has been rising steadily, and this is mainly on the back of the first supplementary budget for 2025-2026, which increased the domestic borrowing target to 996 billion shillings. In addition to that, the latest data shows that inflation is trending higher, and this is mainly driven by rising fuel prices due to the conflict in the Middle East. As a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the impact of inflation. In the primary bond market, the Central Bank of Kenya has published a prospectus for the reopening of 3 fixed coupon treasury bonds, in which it is looking to raise a total of 70 billion shillings for the stated purpose of budgetary support. The central bank, acting in its capacity as fiscal agent for the government of Kenya, is now inviting bids for the following bonds, whose terms and conditions are as follows. The first bond is a 10-year bond that was initially issued in 2022 and now has 5.8 years left to maturity. This bond matures in May 2032 and has a coupon rate of 13.49%. The second bond is a 20-year bond that was initially issued in 2021 and now has 15.2 years left to maturity. This bond matures in July 2041 and has a coupon rate of 13.44%. And for the third bond, this is a 30-year bond that was initially issued in 2026 and now has 29.9 years left to maturity. This bond matures in March 2056 and has a coupon rate of 12.50%. Please note that these bonds are now open for sale until Wednesday, the 8th of July, when the auction will be held. In the secondary bond market, the Central Bank of Kenya has published a prospectus for a switch auction in which it is inviting the current holders of a 5-year bond that matures in November 2026 and is inviting them to switch their investments into a 20-year treasury bond that matures in November 2032. The central bank is looking to switch a total of 10 billion shillings, and the details of the source and destination bonds are as follows. The source bond is FXD1/2021/005. This is a 5-year bond that was initially issued in 2021 and matures in November 2026. This bond has a coupon rate of 11.27% and a current yield to maturity of 8.83%, with withholding tax at a rate of 15%. And for the destination bond, this is FXD1/2012/020. This is a 20-year bond that was initially issued in 2012 and now has 6.3 years left to maturity. This bond matures in November 2032 and has a coupon rate of 12% flat with a withholding tax rate of 10%. Up next is our topical issue, and this week we are looking at two issues, and the first is on the World Bank approval for a Kenyan facility. The World Bank said on Tuesday that it had approved a $750 million budget support loan for Kenya and a sustainability-linked facility that will reduce the country's reliance on expensive domestic debt and bolster economic reforms. The budget support is known as a development policy operation, and it will come in the form of a loan for $340 million from the International Bank for Reconstruction and Development and concessional funding of $410 million from the International Development Association. The sustainability-linked facility is structured as a syndicated loan targeting roughly $500 million, and it will be supported by credit enhancement that reduces investor risk and lowers Kenya's borrowing cost. The World Bank said that the sustainability loan was designed to help diversify Kenya's funding mix and deliver on targets to reduce the rates of deforestation and increase rural access to electricity. And the second issue is on a World Bank commentary on Kenya's foreign exchange reserves. The World Bank has said that Kenya's official foreign exchange reserves are expected to come under renewed pressure, citing rising import costs and a slowdown in hard currency inflows such as diaspora remittances. The multilateral lender links this issue to an escalation of external pressures and sees Kenya's current account deficit worsening to a wider than expected 4.3% of GDP compared to the conservative outlook of 3% by the Central Bank of Kenya. The wider than anticipated current account balance is expected to result in increased exchange rate pressures, which could necessitate the central bank to part with a portion of its foreign exchange reserves in order to curb volatility in the exchange rate. The central bank occasionally buys and sells foreign exchange from the domestic interbank market with a view to supporting demand and reducing excess volatility in the exchange rate. The official foreign exchange reserves have remained relatively stable since the beginning of the conflict in the Middle East in late February, and the Kenya shilling exchange rate continues to trade within a narrow range of between 129 to 130 shillings against the US dollar. And in addition to the above, about 48% of total expenditure for the financial year 2026-2027, which is equivalent to 2.3 trillion shillings, is designated for public debt financing. Essentially, that means that about 50% of the budget is going directly to creditors, tightening the fiscal space available for development and economic growth. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhurij@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, when one door of happiness closes, another one opens. A quote by Helen Keller. Think about it. Thank you, and God bless.